And now at the end of the last vestiges of the fiat money system, and gold and silver will be money once again. And at that point, gold stocks are going to go much, much higher in real purchasing power because they will be the only ones that will be able to pay dividends in real money terms. Everyone else will pay dividends in dollars, which won't be worth much of anything. It might not be triggered on the year-end turn, but it definitely will be triggered at some point. And when it does, the Fed will reverse from QT to QE and push interest rates back down to zero very quickly. That is when I expect the final run of gold versus the dollar to head to the sky. I don't know where the sky is, but it's a lot higher than where I am now. And related to that, I'm just going to take a quick look at the open interest in gold. We are at 450,000 contracts.
The fiat money system is nearing its end, with gold and silver poised to regain their roles as actual money. Gold stocks are expected to rise significantly in real purchasing power when this shift occurs, as they will pay dividends in stable, valuable terms, unlike depreciating fiat currencies. A market trigger, potentially unrelated to year-end events, will likely force the Federal Reserve to reverse from quantitative tightening, QT, to quantitative easing, rapidly lowering interest rates to zero. This shift could ignite a dramatic surge in gold prices against the dollar, with open interest in gold currently at 450,000 contracts, signaling vigorous market activity. Rafi Farber, a financial analyst, commentator, and precious metals, explains from 1969 to 1982, Homestake Mining, a leading gold stock of its time, demonstrated the volatility of gold stocks during a bull market. Between 1969 and 1974, the stock experienced a significant 5 times increase in value during the first leg of the bull market. However, from 1974 to 1980, amid gold price interventions and rising interest rates, the stock became highly volatile, failing to reach a new high even during gold's peak in January 1980. Although it briefly hit a new high in 1981, this was short-lived, illustrating the challenges of timing the market and the risks of holding gold stocks through periods of extreme volatility. Rafi Farber recalls that, in the 1930s, Homestake Mining displayed resilience during the Great Depression. The stock initially dipped slightly during the 1929 crash, but quickly recovered and began a steady climb as New Deal policies and government spending took effect. Notably, after the Dow bottomed in 1932, the stock surged, particularly following Executive Order 6102, which mandated the surrender of private gold holdings. This period highlighted the unique behavior of gold stocks as safe haven assets during economic crises and their potential for significant gains under government monetary interventions. Let's explore the video in more detail. If you find this content helpful, give it a thumbs up and subscribe to stay updated with our latest videos.
From 1969 to 1982, this is the premier gold stock. I guess the equivalent of Newmont would be today. So you see here 1969 to 1974, that is this first box over here, and I labeled it, we have a 5x increase in the first leg of the bull market. From 1974, 1976 was when the Treasury was busy selling gold to try to control its price, and we had a little correction in the midst of a bull market that went into 1980. But from 1974 until 1980, this stock, Homestake Mining, which could be representative of other gold stocks of the time, in January 21st, 1980 top, with gold at 872 and silver at $50. It hit a new high later on in 1981 as interest rates maxed out. However, that was a short-lived high, and good luck timing that thing and expecting that you'd be able to sell at the top in this gold stock, as gold had already topped. Very confusing. I don't expect anyone to be able to sell at a high like this. So you could be saying then, and I would say, why would anyone want to own any gold or silver stocks now, given that this is what the gold stock sector did in the 1970s? Yes, granted, from 1971 to 1980 or 1971 to 1974, it went up 5.5 times. But then it became really, really volatile, and it was not really worth holding on to after 1974 so much. So here's the 1930s bull market, just so you can see how this stock, this is again is Homestake Mining, how this stock behaved through the crash of 29, through the New Deal, through Executive Order 6102, which mandated everyone give up all their gold to FDR, and the Dow bottom is somewhere in there in July 1932. So we see in the crash of 1929, This stock didn't do much of anything. There was a peak here, there's a trough here. It did go down in the crash and the liquidity crunch. This is October 1929, but went up immediately afterwards. It wasn't much of a dip at all. And then as New Deal spending picked up and we ended up into what began as a socialist system and continues to this day, New Deal spending into the 30s. This was as the Dow was falling and falling and falling and bottomed over here where it says Dow bottom. So this stock was going up and up and up gradually into the Dow bottom, but it really took off after the Dow bottom in 1932. And you can see here that it really started to take off after the Dow bottomed and reflated very slowly. The Dow never fully reflated until decades later. I think it was around the 50s or even the 60s, maybe. I don't remember exactly. But the point is here is that Executive Order 6102, when Roosevelt decided to pilfer the entire country's gold supply and stick it into Fort Knox, and most people complied with that, unfortunately, that is when the stock really took off.
Rafi Farber highlights that during the 1930s, Homestake Mining saw significant gains following the revaluation of gold from $21 to nearly $35. The stock's performance accelerated after the Dow bottomed and gradually recovered, coinciding with the transition to a new monetary regime with gold standard-like characteristics. By 1936, Homestake Mining reached new highs, both in absolute terms and relative to the Dow, as the broader market struggled to recover from the 1929 crash. Rafi Farber points out that this historical trend suggests that gold stocks may not fully revalue until during and after a significant monetary transition or economic endgame. Once the current dollar regime ends and markets stabilize, gold mining stocks are expected to outperform significantly, increasing purchasing power by at least tenfold, while offering real income streams, possibly through dividends or product-linked certificates in stable monetary terms. The U.S. Treasury market faces significant risks as $50 trillion in debt strains market liquidity. A breakdown similar to the 2020 pandemic panic when bonds sold off sharply until the Federal Reserve intervened could occur unpredictably, with or without a clear trigger. The concern is that market pressures could randomly destabilize liquidity, causing dislocations. A key risk involves the basis trade, where hedge funds short Treasury futures while buying cash treasuries, exploiting price differences. Previously managed by primary dealers, this strategy depends on futures being more expensive than spot prices. In a liquidity crunch, this dynamic reverses, leading to violent deleveraging. With quantitative tightening reducing cash in the system, the repo market is under strain, heightening the potential for market disruption and necessitating possible Federal Reserve intervention. Now, let's dive into the interview.
And see, here is the gold revaluation from $21 to close to $35. And at that revaluation, that is when Homestake Mining really started to take off. It really took off once the Dow bottomed over here. We have Homestake Mining over here, slightly above it. And then after the Dow started to reinflate slightly, nowhere near as where it was in 1929, but as the Dow started to reinflate after this whole monetary system had ended and we went into a new era of gold standard-esque monetary regime, that is when Homestake Mining really started to take off into 1936, reached a high then. So the point here is that we shouldn't expect gold stocks to really start to revalue higher until during and after the endgame itself. The Dow bottomed here. So once the Dow bottoms and the dollar regime is pretty much over, that is when these gold mining stocks are going to seriously outperform the market. Remember, not only was Homestake Mining making new highs for itself, it was making tremendous new highs relative to the stock market, relative to the Dow here. So I'm expecting in terms of purchasing power that these stocks will go up at least 10 times and they will be able to pay a real income stream in perhaps certificates for their product in real money terms. Treasury's elite bond dealers will struggle to handle $50 trillion debt. Just wanted to go into a few key paragraphs here. Here is the first one that I wanted to highlight. They worry about the potential for the type of breakdown in Treasury market functioning that happened at the start of the pandemic, when investors rushed to sell bonds as panic set in. U.S. government debt sold off sharply until the Fed implemented an emergency backstop measures to limit the damage. The fear is that a confluence of pressures could strain liquidity and spur dislocations even without an obvious fundamental trigger. So essentially, they're saying this is going to happen randomly with or without a trigger, meaning it could happen in the year-end turn, which happens in the next 2 days, or it could just happen randomly in the time afterward. The other paragraph I wanted to highlight is this one. A key risk for the market is that if repo rates surge again unexpectedly and dealers aren't in a position to step in, hedge funds may not have properly factored in that risk, triggering swift and violent deleveraging that would likely prompt the Fed to intervene. Regulators continue to fret about potential disruptions around the popular basis trade. We'll get into that in a second. A leveraged bet that seeks to exploit differences between cash treasuries and futures, given the prevalence of hedge funds on one side, who have stepped into a role formerly taken by primary dealers. This is the basis trade. It should scare the pants off any central banker, especially an American central banker, meaning anyone on the Federal Reserve Board. The blue line is the hedge funds, and it shows how short they are. Treasury bonds is exactly what that last paragraph was talking about, how the hedge funds have taken up the job of the primary dealers. The primary dealers aren't dealing with this for whatever reason, and instead the hedge funds are dealing with it by shorting treasury futures and buying spot. And that depends on futures being more expensive than spot, which reverses itself in a liquidity crunch as we saw in 2020. And this whole thing is forced to wind down. There's much more repo money involved in this. This is the very thing that is going to have to be violently deleveraged if cash runs out in the repo market, which it is, especially because QT continues, or the tightening of the balance sheet, which means that the Fed is taking dollars and retiring them out of existence, and the extra cash is being slopped up out into a black hole.
The impending shift in the monetary system, rising gold and silver values, and mounting risks in the U.S. Treasury market highlight the need for vigilance in navigating these transformative economic times. With their potential for significant gains and stability, gold stocks could become key assets in a post-fiat world, while the Treasury market's vulnerabilities underscore the broader systemic challenges ahead. How might investors position themselves to benefit from a potential gold and silver revaluation in the coming years? What steps can regulators take to mitigate the basis trade risks and ensure Treasury market stability? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.